It is so wild what's happening with Fannie and Freddie.
They basically have a government license to print money.
This is going to go up based on a government decision, not based
Yes.
on the economy or their income or anything like that.
That could completely wipe you out or give you the payday of all time.
Is it possible that with the stroke of a pen, the Trump administration can 10x your money? And what's the big speculative play that has all of Wall Street watching Washington? And how can you end up with a big payday on this little known investment? This is Top Stocks, and we're here today to talk about two of the strangest businesses in the United States, Fannie Mae and Freddie Mac. There's nothing like them, and they take a little while to understand. But once you do, you see there's a chance that these stocks can soar multiple times over in a single day. Now, that's the kind of promise that I normally think is a bunch of nonsense and tell you to quickly run the other way. But this is a wild situation with a history that goes back 88 years. And it comes down to this. I can't promise these stocks will go up, but if they do, they are going to go up a lot. I've got the perfect guest to talk about this today. With me is Whitney Tilson. Whitney is a former hedge fund manager, a friend of Warren Buffett and Bill Ackman, and he knows, it seems, just about everybody on Wall Street. I'm an investment analyst and economist with over 2 decades of experience, but more importantly, I have a huge, experienced research team at Stansberry Research that has done all kinds of incredible things. They've predicted the dot-com bubble and the financial crisis, recommended Berkshire Hathaway at $56, it's at $500 now. Recommended NVIDIA in 2016, Bitcoin in 2017. This is just what we do. Whitney, thank you so much for joining me here in person. Look, I can't get enough of this story. It is so wild what's happening with Fannie and Freddie. And we're going to talk about the opportunity. We're going to talk about why these companies matter to everybody, even if it's just because you own a home. We're going to outline what might come next and just how big the gains might be. And of course, stick around. We'll talk about the best way for an everyday investor to play this. So set us up, Whitney, with the big headline here. What's going on with Fannie and Freddie that could lead to big stock gains?
Well, they, as background for viewers who might not be familiar with them, they're the two government-sponsored entities called GSEs. And they were set up by Congress many decades ago to provide stable and affordable mortgages for Americans. And we're one of the few countries that benefits from having 30-year fixed rate mortgages that at the homeowner's discretion, if interest rates drop, you can refinance lower. But if interest rates rise, a lot of homeowners today have 3% 30-year mortgages because they took the mortgage out a few years ago. And now mortgage rates are 6.5% or so. And they're still paying 3%. That's most Americans don't fully appreciate how lucky they are to have this system. So these two GSEs, government-sponsored entities, the government-sponsored piece of it means they exist in this quasi-public-private world where they basically have a government license to print money. They are two of the most insanely great businesses of all time because of that government guarantee. They have the backstop of the U.S. Treasury. They access capital at super low rates. And basically, their main business is just buying mortgages that are originated by banks and mortgage lenders. It's the world's largest debt market. They have a combined $7.8 trillion of mortgages that they've guaranteed. And they just charge a G fee, a guarantee fee, that used to be 20 basis points, 0.2 of 1 percentage point. That was, back pre-financial crisis. It's now 65 basis points. So they're making more than triple the profits they used to be. And they were among the greatest businesses even before their guarantee fee tripled. So the two businesses mint money. They made $25 billion of net income last year. Okay. And their market capitalizations today are around $60 billion, of which the government owns 80% of it because back in the global financial crisis, now 16, 17 years ago, they became insolvent. They went bankrupt, and to stabilize the financial system, the U.S. government basically took them over and did a huge bailout, $193 billion to both of those entities. And in exchange, the government has today, it grows by the day due to some arcane accounting, but call it $365 billion of senior preferred securities and the government has warrants for 79.9% of the stock. So in some ways, the bailout of these entities, it was done for many financial companies. AIG, for example, had a similar bailout. Most of the major banks, JP Morgan, Citi, et cetera, got bailed out. The GSEs, in part, I think, for political reasons, have not been allowed to exit this government conservatorship that they're in. So there's a lot of weird stuff going on about whether the stocks, which now trade on the pink sheets, for the last 17 years have traded on the pink sheets, there's a raging debate about what they're worth. Nobody disputes that they're two of the greatest, most profitable businesses in the world, and that were they independent companies, minting this kind of money would have a high multiple and would be worth 10 times what they're trading at today on the pink sheets.
Okay, so if they go public/private, it's kind of odd to even pick which way to phrase that. These stocks could jump because they might be worth a lot more than they are now, because they're not really worth anything, the public shares, right? There's like no residual value there.
Well,
as of now.
Yes, there was, when they were originally put into conservatorship during the financial crisis, there was a fairly standard agreement where the government took warrants, i.e. took control of 80% of these effectively bankrupt entities, and the money that they lent had to be paid back at 10% interest. And there was a similar deal for AIG, somewhat less onerous for the other major banks. What happened under the Obama administration is that in 2012, as the country emerged from the global financial crisis, the housing market recovered, all of a sudden the GSEs became incredibly profitable after years of big losses, where the government, as I mentioned earlier, had to put in $193 billion to stabilize. Well, now the GSEs started to mint money, and since then have paid back the government's $193 billion plus 10% interest, plus another $25 billion on top of it. They've paid back $301 billion. So, and we American taxpayers should be happy that they've remained functioning and providing these 30-year fixed rate mortgages that we all benefit from. And two, that we've been more than paid back. It turns out, if you do the math, we've earned 11.6% interest, not the mandated 10%. So there's an extra $25 billion the Treasury has pocketed, and we still own 80% of these companies. And the Trump administration is looking to partly for philosophical reasons. They want this privatized, these businesses privatized, just philosophically, small government types. But also they see a potential huge windfall for taxpayers. If you take $25 billion of net income, put a 12 multiple on it, which would be quite low, you get $300 billion of market capitalization, and nobody disputes that the government has 79.9% of that. That's $240 billion. That, for example, the Trump right now is asking Congress for $200 billion of supplemental funding to fund the Iraq war. Like that would fund the entire Iraq war so far, that request. So that's big money. So the stocks, after languishing, around $1 a share, because it wasn't clear they would ever exit conservatorship and all, since Trump was elected a second time, a little over a year ago, the stocks took off. Fannie Mae stock went from $1 to $16. And now with the Trump administration being distracted by the Iraq war, concerns about inflation, Trump's popularity numbers going down, there's now concern by Fannie and Freddie shareholders, will the Trump administration be too distracted or not have the political capital to do what might be a politically difficult thing to do, which is, release these companies from conservatorship and have them be, normal companies trading on the major exchanges, not the pink sheets, et cetera.
Well, they still won't be normal companies, but let's go into all those things we just talked about. But I want to start with what do Fannie and Freddie even do? They make a big difference in our economy and our mortgages. People should kind of understand this stuff, and most people don't. So what what's their role in the mortgage market and
Sure.
the economy?
Well, it's the world's largest debt market is mortgages on U.S. homes,
Mhm.
and it's most people think a bank makes a loan.
Yeah.
They borrow money at 4%, they lend it at 6.5%, they make a spread,
Yeah.
and they just hold the loan.
Yeah.
Most people would think that's how it works,
That's
but
the old "It's a Wonderful Life" model. Yeah.
exactly. And what really happens is the people who make the loans instead flip them to Fannie and Freddie, the
Mhm.
vast majority of mortgages in this country. Fannie and Freddie then bundle them up into securities with the, at this point, pretty explicit guarantee
We'll
of the
get to that.
backstop of the US government.
Yeah.
And so Fannie and Freddie securities trade very close to treasuries. They're
Mm.
viewed as, AAA
Yeah.
because of the imprimatur of the US government.
And mortgage-backed securities and securitization kind of got a bad name in the financial crisis,
Sure.
which we'll get to. But I mean, that was unfair. When you bundle these things up and you can spread this risk around, that drives interest rates lower, right? Like if you were just meeting a person, deciding what to lend them at, you would give them 8% or something like that. But
Right.
when you can say, oh, I'm just going to own a little piece of thousands of home loans, you're willing to charge those borrowers a lower interest rate.
Sure. The system actually, despite the taint of the securitizations and how everything went awry going into and then the piper got paid during the
Yeah.
financial crisis. But what had happened is Fannie and Freddie had chased growth,
Mhm.
and they did not act to rein in the subprime mortgages, the interest-only mortgages, the HELOCs, all the toxic types of mortgages that were out there fueling this bubble. Fannie and Freddie, to their everlasting discredit, kept buying these mortgages when it was clear that there was a lot of bad lending going on. And yet they still only held a tiny, tiny sliver, like 1/20th of 1% reserves, because historically they had never had any losses ever,
Right.
because housing prices had always gone up. So
Mhm.
for decades, that had lulled everybody, regulators, politicians, and the executives of the firms, everyone in the mortgage market. So when the housing crisis hit, these companies were, caught swimming naked, as Buffett would
As
say.
Buffett would say. So the part of what they also do is they guarantee these loans. So it's almost like an insurance company. They take a little premium,
Yeah.
and then if these loans go bad, they will pay back the investor on these mortgages. And by they pay back the investor, what it really is an implicit guarantee. Everybody says, okay, these things are too big to fail. They're kind of a government entity.
Mhm.
If these mortgages go bad, we all know the government will cover them,
Right.
even though the government doesn't actually say, right? It would be explicit if they said these are government guaranteed. They don't say that.
Right.
It's just kind of known, which is why it's an implicit guarantee.
Yes. And once the companies were put into conservatorship, the
It became-
implicit guarantee that had existed for decades became explicit.
Yes.
The US Treasury basically gave them an open line of credit to prop them up. Initially, it was $1 billion. It ballooned to $193 billion that went to the two GSEs. But it's all worked out beautifully, knock on wood,
Yeah.
so far. And I, by the way, do not see signs of, any looming trouble for these companies. The mortgage standards and underwriting have remained strong. And these companies are now getting paid quite a bit more. The guarantee fee is more than triple what it used to be. So they're minting money at this point. Now, they're somewhat cyclical in that if there's a big economic downturn or a big housing downturn, their businesses could slow somewhat. They could incur some losses, but they're in good shape right now.
Okay. So, and just you were talking about lending standards. When people talk about conforming loans, that kind of means your credit and your mortgage is good enough to end up in one of these packages. And that also is what drives the 30-year fixed rate, right? Like those are what Fannie and Freddie focus on. And in other places, there's a lot more ARMs, there's a lot more short-term loans, but kind of because of the way Fannie and Freddie are set up, we are a country with 30-year fixed rate mortgages and relatively low. Everybody's complaining now because rates are higher than they used to be, but
Right.
still pretty affordable loans.
Certainly relative to other countries, which, higher interest rates are a global phenomenon, of course. But we have lower spreads. And again, that 30-year fixed rate mortgage with the option to adjust.
Yeah.
You can refinance if interest rates drop.
I know.
And but the lender is stuck if interest rates go up for 30 years. It's one of the things causing our housing. I'm digressing somewhat here,
Please.
but one of the reasons the housing market has sort of become paralyzed is how housing prices have gone up so much. And then the affordability, when you combine rising prices with higher interest rates, means people can't afford houses anymore. But if you sell your house and you have a 30-year fixed rate mortgage, let's say with 25 years left on it, and you're at 3%, if you sell that house, you give up that mortgage. There's no way to transfer it to the buyer. And now you're faced with buying another house at 6.5%, paying 6.5%. So there's sort of a buyer's strike because they can't afford the house with the higher interest rate, and the seller's strike because they don't want to sell and give up the most valuable financial asset in the world. Is 25 years left on a $500,000, a $250,000 loan at 3% in a 6.5% interest rate environment.
And I think that's feeding into the lack of our dynamic hiring environment, because people can't move for a job or anything because if they keep the same house, their mortgage rate could double or even triple in some cases.
I think an interesting policy idea would be to allow transferability.
It's been talked about.
That mortgage, because it would ease up the housing crisis.
Okay, so back to policy then.
Yes.
So these companies have to have a buffer, just like a bank, right? You can loan this much money, and you have to keep a small percentage, and hopefully you don't face losses larger than that, and you have your buffer there. And in 2008, their buffer was way too small. Like they got way too big. And so they needed this bailout. So tell us sort of the parts of that bailout and why, then I know they've had a few amendments since then, which leads us to where we are now.
Well, there are a number of moving pieces as you think about what the value would be to the common shares, which is at the bottom of the stack. One of the pieces you just mentioned is how much buffer to reserves against losses. There's something that came into effect in 2020 called the Enterprise Regulatory Capital Framework, ERCF, which picked a number out of the air, 4%. And when you do the math on 7.8 trillion, it comes out to a bit over $300 billion. The actual published number out there today is somewhere, it's $334 billion.
Okay.
The GSEs combined today have 179 billion of reserves. So there's a $255 billion shortfall today. So that's also a claim senior to the common equity. And so the GSEs are regulated by the FHFA, Federal Housing Finance Agency, run by a guy named Bill Pulte. He has, without Congress's approval, the FHFA can wave its magic wand and reduce the capital cushion to 2.5%, which would get you almost down to, that would be about $190 billion, and they're at 179. In other words, 6 months of earnings would easily cover that. So one of the many governmental decisions that will determine how much the shares are worth here is, are they going to wave that magic wand and reduce the cushion? Now, historically, these companies have had losses not of 4%, not of 2.5%, but of 0.05%, like 20 basis points, 1/20th of 5 basis points, which is 1/20th of 1%. So I think you could comfortably do that. And we, the taxpayers, the American people who are backstopping that $7.8 trillion of guarantees and mortgages, the GSEs own, we would be in plenty good shape. But keep in mind, this is to analyze these companies today and analyze the stock is more of a political analysis than it is an economic analysis. The politics of taking north of 4% reserves that are protecting the American people from
Yeah.
having to bail out the GSEs again. Taking that down to 2.5%, which is a more sensible number economically, but politically, you can imagine what Elizabeth Warren's going to have to say about that.
It doesn't look good.
And,
Yeah.
and it'll look like a gift to penny stock speculators / hedge funds and Trump's donors and so forth.
Yeah.
The counter argument, of course, is keep in mind, we, the taxpayers, own 80% of this. So
Right.
any gain in the stock
Is good for us.
is good for us. We're going to pocket 80 cents on every dollar.
Whitney just explained to us the role of Fannie Mae and Freddie Mac in our economy and how this is more of a political analysis rather than an economic one. And you need to know that Whitney's the real deal. He rubs elbows with Bill Ackman and Joel Greenblatt, and he bakes cookies for the legendary investor Warren Buffett every Christmas. CNBC once even dubbed him the prophet for his string of eerily accurate market calls. Which is why when Whitney starts ringing the alarm bell, investors should pay attention. He calls his latest prediction America's ripping point and believes the country is entering a stretch of upheaval unlike anything he has seen in his career. It's all due to artificial intelligence and how it's beginning to tear the economic fabric of the nation apart. It will create massive new fortunes for a small group of people while ripping away the livelihoods and security of millions of others. But Whitney's message is not all bad news. He insists this turmoil also carries huge opportunity, and he just filmed an exclusive interview with a step-by-step plan to help everyday Americans use AI in their own investing. You can watch it for free at www.rippingpoint.com. That's www.rippingpoint.com, or click the link at the bottom of your screen. Okay, let's talk about those economics some more and then come back to the politics. Because all right, so let me see if I got this right. We got the bailout of whatever it was, 190 billion.
193 billion. Yeah, back in the day.
At first, the government owned these preferred shares. Well, they still own those, but they got those preferred shares and they were going to get paid 10% on
right.
them.
Yeah. So keep in mind, there's preferred stock and warrants. So the warrants are for 79.9%.
Yeah.
I just rounded to 80.
Yeah.
80% of the stock and the preferred shares.
Yes. So those preferred shares, we were supposed to get 10% on them, but then in 2012 or something, they did this capital sweep where they got all the income, whatever positive profits Fannie got. And I'm going to say Fannie, but it's Fannie and Freddie. They're the same.
It's affected them both the same.
So we started collecting, as the government, we started collecting all that money. So we put out 191 billion in the bailout. We collected 300 billion back. So we're already ahead plus interest. Right. Now sitting there is they still own 300 billion worth of preferred shares that would have to be
360 billion.
360 billion. Yeah. So those would have to be paid first, in a sense.
Well, that's the question. That is a political decision. Right. It's a political decision because there is, I would argue, on a purely rational economic basis, the way every other bailed out financial institution was treated, the government should declare that this has been paid off and just cancel the senior preferred and by the way, pocket the extra 25 billion you swept. Yeah. Right. Yeah.
Because we owe them 300 billion. The company's worth about 300 billion now. If you do, it's somewhere in that range, right? Fannie is worth that, but the government gets to claim all of it.
Fannie and Freddie combined.
Fannie and Freddie combined is worth about 300 billion. Right. The government has that $360 billion claim plus the warrants. And then also, as you said, they haven't built their capital buffer because of this capital sweep. Right. Now they're up to 180, so they'd have to get another 120 billion to meet that 4% target. So and the shareholders don't really get anything until all of that is cleaned up. And those are the questions.
Correct. And we haven't even talked about the junior preferred, which is a debt/equity like security that's senior to the common that is trading at a discount, and there's there could be a haircut there as well. So the key variables, if you were to boil them down, is will there be any adjustment to the reserve requirement? Secondly, what will there doesn't appear to be any dispute that the government is going to keep its 79.9% warrants. So that's not really a variable at this point. Everyone's in agreement. What does the government do with the senior preferred securities? Because basically the U.S. Supreme Court basically blessed all this.
Yeah.
What I would argue was outright theft from the companies and all in an unprecedented move. Didn't matter. The U.S. Supreme Court said, you guys are in conservatorship. Government can do whatever it wants. So anyone thinking about investing in any of either the common stock or the junior preferred here needs to understand that the government at its whim can wipe you out to zero. And there will be no recourse in the courts. The courts have already ruled on this. The question is if the government does that, it does two things. One, wouldn't make sense for the government to do that because, one, they've just wiped out their own 80% stake that could be worth $240 billion if they play their cards right. But two is, look at what happened. Remember when Silicon Valley Bank got into trouble a couple years ago and all? And the government was frantically, trying to find buyers and all. But the fact that the government has shown that, hey, people can come in. People put money into Fannie and Freddie before the global financial crisis, and they got wiped out. And so if the government treats private investors badly here, it will make it very difficult, if not impossible, for the government to ever attract private investors to come in the next, not necessarily even global financial crisis, anytime any particular bank gets in if the government acts in an arbitrary and capricious way here. There are three possible outcomes on the senior preferred securities. That's the biggest chunk here. One outcome is to cancel it. That would certainly be best for the shareholders and the junior preferreds. The other is the opposite extreme, is to convert all of it, and basically you've now wiped out the shareholders. It's a zero. But there is discussion, and Mike Burry's been discussing this, making an argument for the government retaining and converting 25%. Now, why 25%? Because it reduces the windfall. The government, again, this is all political. The government doesn't want to be seen as handing, some very large shareholders. Bill Ackman of Pershing Square owns 10% of Fannie Mae, et cetera. So doesn't want to. You would, if you look at, various assumptions, you get to $33 a share on Fannie stock, for example. Freddie would be a few dollars less. And they're currently trading at about $6.50 and about $5.50 a share, right? So you'd be handing a six-bagger win from today's price if you just cancel the senior preferred. If the government sort of converts 25%, you knock that $33 down to $17, roughly speaking. So it would be sort of splitting the baby kind of outcome. So the other variable is, does the government convert the junior preferred if they convert it at a 40% haircut to par value? Because the government doesn't want to just give a big giveaway to all the hedge funds that own that security as well, right? So that affects the common, of course, whether the junior preferred, which is senior to the common, gets a haircut or not. So you can see there are sort of multiple moving pieces here. A lot of it's political. And, look, when politicians are making decisions here, you can throw economics out the window and you can say, okay, what is the Trump administration's pattern of behavior? Who have they brought in, et cetera? I would say plus that makes me bullish on a good outcome here for the common stock is they had a guy named Mark Calabria who was head of the FHFA back in Trump 1. And he basically was super anti-shareholders and felt like you're just speculators. The government bailed you out. Had we not bailed you out, you would have gotten zero. So he was in favor of just wiping out the junior and the common shares. Trump tried to get rid of him and couldn't. But when he got reelected for Trump 2, he moved Calabria over to the Office of Management and Budget and brought in 37-year-old Bill Pulte, who's much more pro, IPOing these companies. seems and that's why the stocks, by the way, went
They've
from
been moving.
$1 to
Yeah, yeah, yeah.
$16. In the case of Fannie, almost the same for Freddie. So now the stocks have pulled back a lot, though. Just, they were talking last year about getting an IPO done first quarter of this year. Obviously, that's not happening.
Yeah.
Mike Burry now thinks it's not even going to happen this year at all. Maybe something will happen in 2027. But he sort of argues, look, the default scenario is nothing happens.
Right.
And things keep going the way they are. But keep in mind, that's not a horrible scenario. The companies are still minting money.
Mm-hmm.
They are now building capital, and so helping close that gap.
Yeah.
But look, if the Trump administration just announced tomorrow, we're just not going to do anything on this. We're not going to spend any political capital. This is just too hard. We'll leave it for whoever the next president is. The downside on the stocks is probably $2. Probably wouldn't go back to $1.
Yeah.
So, there's still quite a bit of downside. But we're just over a year in. Trump's got almost 3 years left.
Yes.
He may choose not to fight this. I wouldn't expect anything to get done before the midterms, again, just for political reasons. It's sort of a political hot potato. But once he's a lame duck, and this does not require congressional approval. This is all by sort of fiat.
Yeah.
If they can structure a deal here that is consistent with, privatization ideology that, let's be honest, would, be a big windfall for, yes, some of Trump's biggest donors, but also for the government. And Trump could claim a big $240 billion gain for the government stake here. And, we're getting the government out of the mortgage market and it'll be more efficient, et cetera, et cetera. Like, I could easily see that happening in the second half of Trump's term.
And the warrants expire in 2028.
Yeah, September 28, but that could easily be extended.
That could be extended.
So I don't. That is sort of a catalyst.
Yeah.
But there's no scenario under which the government's going to allow those warrants just to expire.
Okay, so Bill Ackman's he's the one who kind of has popularized the grand plan of, if you do all these 5 things, these shares go from 6 to 35, and all those things can be set at kind of different levels, and maybe it doesn't go all the way up, but Michael Burry's on board.
Yes.
Bill Pulte, like you said, is on board. Lutnick, Besant, they've all talked about these, but like you said,
Trump himself.
And in like November of last year, that there was like a big push. They were like, we're going to do it right away. And I think they just got distracted with, wars and other things like that. Maybe it's not on the top of their radar. But I want to.
And by the way, investment banks were coming in. I know from my sources that, JP Morgan and all the big banks, this would be one of the biggest IPOs in history.
Yes.
So they were all coming in doing their presentations to Lutnick, is my understanding, was the one, Commerce Secretary Howard Lutnick. So I think it ended up, like you said, some war, the wars and other things have been a bit distracting. And also, this is just really complex. It's really, it's hard. And
that's what I wanted to talk about next, because you can view this through so many lenses and it looks like a great idea and very fair. And then on the other side, you can go, this is totally unfair. And the politics of that are really complicated. So like you said, there's an issue of fairness, right? Should these shareholders have been wiped out? And if they shouldn't have been, then we should give them back the company. And they've paid back, the companies, we've paid back the bailout. And it's good for business in the future, like you said. So that all makes sense.
Right.
And it's actually a good financial deal. The government is entitled to these $360 billion in preferred shares. But if they're kind of not ever going to get that, then they're better off taking the $280 billion of 80% ownership. So it makes sense on paper too. But like you said, the beneficiaries of these are speculators who own these stocks, and there's not a lot of sympathy to say, hey, yeah, let's go make these huge policy changes and figure this whole thing out so that these guys' stocks will go up. It doesn't sound that sympathetic. So it's an odd. I think a politician on either side of the aisle would just sit there and say, let's just wait. Like, leave this mess for the next guy. Right. So that's the risk. Like, that's why it might take a while.
Right. And the other unknown variable is what happens to mortgage rates, because if privatizing the GSEs in any capacity, in any way, disrupts the mortgage market and rates go up, somehow spreads go up, the market becomes less efficient, that's a political disaster. And that's sort of an unknown.
And Bessent and Lucknick have both been like, that is our number one thing. We're not going to let that happen. Now they say that, but yeah, that's a huge, if that were to happen, it would be a political disaster.
Yes. I think there's some room. I mean, you would think the government initially, the government could make their guarantee explicit and charge for it. And part of it is, and by the way, if the conversion, it wouldn't be, if the government keeps 25% of the senior preferreds on the conversion, the government's going to own 90%, not just 80% of this entity. So they can sort of partially cram down the quote speculators / investors. Such that they do okay, but the government can say, we captured the vast 90% of the value for the American taxpayer. We're going to make our guarantee explicit, but we're going to start charging for it. So the GSEs are currently pocketing the full 65 basis point spread. They were quite profitable back in the day at a 20 basis point spread. The government could say, we're going to charge for that. And so in addition to owning 90% of the upside on the equity, they could be pocketing, because the government over time will probably want to exit in the same way it did with AIG, where it owned 80% of AIG and then sold it off in 2011, 2012, if I recall, over, in an orderly fashion over the course of a couple of years. But then the government could retain that guarantee fee stream, which is huge amount, could be, I don't know, $20 billion a year. Indefinitely and growing. That's super valuable.
So, but what's cool about this, and I want to talk about how an investor at home, if they find this, it's a speculation.
Yes.
How to approach this, because what's cool about this is there's not a lot of opportunities out there to 5x or 10x your money. Like it's, you could take whatever you want to take. NVIDIA, I don't know, are they $4 trillion now? How can they get to 40 trillion, right? It's hard to 10x things. And it's uncorrelated to the rest of the market to a degree. This is going to go up based on a government decision, not based on the economy or their income or anything like that. So those are appealing things to find in an investment.
Yes. I mean, it's a political speculation as opposed to, most, I occasionally recommend and take speculative investments myself where it's based on an economic analysis. In this case, I think you should be clear it's a political speculation. All the people from President Trump to Lutnick to Bessent to Pulte are all in favor of a particular outcome, and whether they have the willingness and the stars align for them to push this probably after the midterms to get something done. And by the way, it could simply be uplisting the stocks to the NYSE, which is where they had always traded before getting downgraded to pink sheets when they went into conservatorship, but also issuing just some clarity about the senior preferred without even doing an IPO could be a catalyst as well. So size it appropriately. I would tell anyone, 1, maybe 2% of your portfolio. Prepare for quite a bit of volatility. Bill Ackman put out a tweet saying, the stocks after Fannie had fallen from 16 to under 5 just a few days ago, put out a tweet saying, it's crazy cheap, has 10x upside, and the stock rips 40-50% in a day or two. So that's great on the upside, but it can also work in reverse. So expect a lot of volatility and tuck it away. And I think it's one of the most interesting, attractive risk reward speculations. But I emphasize the word speculation.
Yeah. And like you said, I don't think people think about their portfolios this way, but maybe they should. If you're trying to make, I worry that someone hears, ooh, this could be a 5x or a 10x, and they put a ton of money in it.
Right.
But really, like, you should be trying to earn 10 or 20% a year on your portfolio. And so if you just put 1% in here and it's a 10x, well, now you've gotten half your returns all in one trade, right? So you got to kind of claw for every basis point throughout the year if you're an active investor. So you want to keep it small and get that big reward if it works out, because it's risky and it's hard to
Yes.
tell. It's hard to tell where this will go, but there are not a lot of trades like this. I think that's what Burry said. He said there's just not this kind of asymmetric setup in markets very often.
Yes.
Okay, so one last question. I've looked it up on Polymarket, or maybe it was Kalshi, I forget.
Okay.
What are your odds that, let's say, by the end of 2027, what are the odds that this goes through, or at least is like approved and like the stock has reacted because it's going to happen?
Yes. I would say there's a 50% chance that nothing happens.
Okay.
That they sort of grind along, and there's still some potential that something might happen and the stock's sort of flat. There's a 25% chance that it becomes clear the Trump administration isn't going to do anything. And then it will start pricing in, are we looking at a JD Vance administration or Rubio administration,
gosh,
Republicans getting reelected in 28, or having a shift?
But just once, this is fairly bipartisan as well. I mean, I think the optics are a little different for Democrats, but it's not, it won't be shut down if a Democrat.
It wouldn't be shut down.
Yeah.
Just the Democrats are perfectly happy with the status quo and feel no urge to privatize in any way. And, under Biden, the stock's traded at $1 a share.
Yeah.
So I think there's sort of been enough movement and all that I think $2 a share is probably a realistic downside.
Mhm.
So at 650, you sort of got 2 on the downside in a 25% scenario. Sort of nothing happens in a 50%. And then the upside is a double, 2 to a 5 bagger,
Okay.
I would say, depending on what the government decides to do with the senior preferreds mostly and on the reserves, I would say. There are all sorts of moving pieces on the upside. I don't think to get to 10x upside from here. In fact, if the government somehow just gave up its warrants, that's where you start to get $100 a share on this.
Yeah.
But I don't think there's no reason the government would do that. The best case scenario would be canceling the senior preferreds and saying, you've paid us back. That disappears. And then the second best piece of information would be reducing the reserve requirement down to 2.5%, such that they're effectively at that already.
Yeah.
And then, it makes a $1 or $2 a share difference on the common stock, whether you cram down the preferred shares by 40% or give them par, give them a windfall. But the first two are the biggest variables.
Are Fannie and Freddie a buy, sell, or hold?
A buy for sure, but keep in mind a speculative buy. There's a wide range of outcomes. There is a zero scenario where you lose 100% of your money.
Yeah.
More realistically, I think, a downside where you lose 2/3 of your money, and the stock, languished at very low levels for more than a decade. So I think the upside here is 2 to 5 times your money, and that offsets the downside risk. But there's a wide range of outcomes, so size it appropriately.
Yeah, I love that you focus on the risk before the opportunity, because that's important. But this isn't like Coca-Cola where it's going to be there in a year. This has a wide range of outcomes, but that upside is pretty impressive.
Yes.
Okay. And then the last thing we tend to do is we decide if what we've talked about is a top stock. That's the name of the show.
Okay.
This one's a little odd because it's definitely a top business.
Yeah, I'd put it as a top speculative stock.
I was going to call it like a top opportunity, right? Because if you could own Fannie outright without all this mess, that's definitely a top business.
If you could own one of the world's greatest businesses at 2 times earnings, you would buy that all day long.
That would be phenomenal.
The question is, you got hundreds of billions of dollars of possible capital senior to you, and completely based on the whim, political whim. What happens to you that could completely wipe you out or give you the payday of all time, or most likely somewhere in between.
Yeah. All right. Well, we'll call it that. We'll call it a top business and a top speculation. Keep it small. This is unlike anything you've probably ever bought before. But it's definitely fun. And I mean, we find it fun to dig into this stuff. I don't know if everybody does, but it's There's a huge story here. It's very interesting stuff. So thanks for explaining it all, Whitney.
My pleasure.
Nothing we say today should be considered investment advice and should be used only for informational purposes.